Still about 3 weeks or so away from the December FOMC meeting on the 10th of the month. However, the path to a rate cut at that meeting is getting narrower by the day, it seems, at this point. And actually, it has been for quite some time now. Of course, Chair Powell started this sort of hawkish reassessment all the way back at the October press conference, where he was mentioning that another rate cut in December is far from being a foregone conclusion. Since then, we've had a lot of hawkish rhetoric from a number of regional Fed presidents. And then, of course, we had minutes this week from the October FOMC meeting, which pointed to many participants not viewing a rate cut in December as being appropriate. In the aftermath of the jobs report that we had yesterday, with the US economy adding 119,000 jobs in September, although that data is stale, it is, of course, the last jobs report that we will get before that final Fed meeting of the year. And quite frankly, the report wasn't great if you dig into the details. A lot of job creation coming from healthcare again, unemployment rising to cycle highs, and a downward net payrolls revision. But the data wasn't bad enough to force those hawks into changing their minds. So the base case now becomes that the Fed actually stand pat at that final meeting of the year, and the Fed funds rate remains unchanged. That in itself is a little bit peculiar, because if you look at the Fed's forecast, they expect unemployment to end the year at 4.5%, which is where we currently are. Headline PCE to be at 3%, which is basically where we currently are. And back in September, they assumed that economic combination would necessitate 3 rate cuts. Now, they don't seem to think the same thing. Having said that, the bigger issue for me is that if the Fed stand pat in December, they're effectively committing to holding rates steady in January as well, unless there is a material deterioration in the data between those two meetings. Quite simply, it would just be odd to stand pat in December if you know you're going to cut a month later. And also, with this framing of risk management cuts, you would assume that if you stop easing, policymakers believe that that risk has been managed, and they then shift to a much more reactive mindset. And that reactive approach means that the next live meeting, if the Fed stand pat in December, is probably not going to be all the way until March. And while we will have a lot more data by the time of that March policy meeting, by the time that data comes through, and by the time the data may be bad enough for the hawks to actually turn and vote in favour of further rate cuts, then it could well be too late, and the Fed could have fallen quite a long way behind the curve. So it looks increasingly likely that the Fed are going to stand pat later this month. Does that prove to be a policy mistake? Well, only time's going to tell.